So in bill for collection, remember the bank does not give undertaking. It's letter of credit that bank give undertaking. In bill for collection, the bank is only a channel for the transmission of document and collection of. Thank you very much for stopping by on DBA TV today. My name is Dela Imibo, and I'm your expert doctor. In this video, I'll be talking about how to mitigate export business risk. Aside this series, I've discussed how to mitigate export business risk using letter of credit. I've talked about how to mitigate the export business risk using confirmed letter of credit. I've talked about how to mitigate export business risk using standby letter of credit. I've talked about how to mitigate export business risk using demand guarantee. I've talked about how to mitigate export business risk using counter guarantee and counter standby. In this video, I'm talking about how to mitigate export business risk using availisation of bill of exchange. Now, this will make me need me to unpack some things first before I go to that availisation. I will talk about that at the end. Let me explain. Now, a bill of exchange is often used in the payment method like letter of credit and bill for collection. Another name for bill of exchange is draft. Another name for bill of exchange is draft. Now, this bill of exchange being used in letter of credit or bill for collection is used as a financial document to demand for payment. Now, when I demand for payment using a bill of exchange as financial document under letter of credit, it is the bank, remember, letter of credit is an undertaking of the buyer's bank, given to the seller, which give assurance of payment when shipment is made and documents are presented that conform to the terms and conditions of the letter of credit. When shipment is made and documents are presented that conform to the terms and conditions of the letter of credit. Letter of credit is an undertaking of the buyer's bank. Now, in this arrangement, if the draft is on the letter of credit transaction, it is the issuing bank that will sign and endorse it. It is the issuing bank that will sign and endorse it. Now, is the one that will sign and endorse it because it's the one that gave undertaking. Is the one that gave undertaking. And this is very important. Is the one that gave undertaking. Now, in bill for collection, he is not the one that gave undertaking. It is the importer that gave undertaking in bill for collection. That means in bill for collection, importer give undertaking by signing a bill of exchange, telling the exporter he will pay. Now, that's now a risk. What if he does not pay? What if he does not pay? How do we mitigate the risk in a bill for collection transaction in case the importer is insolvent, he cannot be found, he didn't collect document, or he collected document and refused to pay? How do we mitigate that risk? Now, a bill for collection have a bill of exchange, a document that enable importer to give an unconditional undertaking to pay at maturity. So in bill for collection, remember the bank does not give undertaking. It's letter of credit that bank give undertaking. In bill for collection, the bank is only a channel for the transmission of document and collection of payment. In bill for collection, the bank is only a channel for transmission of document and collection of payment. So when I ship the goods, I'll put my document together, the invoice, the bill of lading, the packing list, the inspection reports, security of origin. I put them together. I will send them to my bank. My bank send them to the importer's bank. The importer's bank release them to the importer. In the case of what I'm talking about, the importer sign an undertaking to pay at maturity. This, of course, a tenor bill for collection because there's one that is signed, the bank give him the document and collect the money immediately. But that's not the one we're talking about. We're talking about the one that involves draft. Now, Immediately, the importer signed the draft or bill of exchange and give it to the bank. The bank then avalize. What does that mean? Availisation is the act of guaranteeing an accepted bill of exchange. When a bank guarantees a bill of exchange already accepted by an importer, that means in addition to the undertaking of the importer, the bank is saying, we, the bank of the importer, give you undertaking to pay you. We give you undertaking to pay you. That means if the importer fails, having accepted the bill of exchange, if he fails to make funds available at maturity, which is usually 30 days, 60 days, 180 days, we will pay. We will pay. What then does this mean? What exactly does this mean? Because you are saying we will pay. What is the implication of this? That means the importer's bank is giving a guarantee, an undertaking. So if you have a bill for collection transaction and you want the importer says he will pay at a later date and you are not comfortable and you say, okay, can you get your bank to avalize? And he say yes. In the contract you are signing, you put it there that the bill of exchange will be avalized. Then you get your bank to send a message to that bank that you have signed an agreement with this customer and he has said you will avalize. Can you confirm you have an instruction from him to avalize before you ship the goods? Because you need to, so that when you send document, the bank know that is obligated to pay if this guy failed to pay. The idea is to ensure you confirm the decision of the importer's bank to avalize the bill of exchange. Confirm the decision of the importer's bank to avalize the bill of exchange, meaning the importer's bank have agreed to avalize the bill of exchange and pay. Importers have agreed to avalize the bill of exchange and pay. Because the importer have agreed to avalize the bill of exchange and pay, you can go ahead and ship and then present document to your bank. Your bank send that document to the importer's bank. And the importer's bank give it to the importer to accept, collect the document. Upon maturity, if the importer now fails to pay, his bank will pay because the bank already give undertaking. And when the bank give undertaking, know that the banks are not in the business of taking unnecessary risk. The bank already protect themselves. They already make provision for it. So they wouldn't be looking for the money at the time you are presenting document or at the time when payment is due and they refuse to pay. That's why we also need to check that the bank is the bank that have integrity and they will do what they said they will do. I hope this video has been of help to you. Are you into bill for collection transaction? Do you have concern about your payment? Then this video will have helped you. Give it a thumbs up. In this video, I've given you some additional information to help you. And by the way, if you have such arrangement, a bank will also fund you. If a bank confirms they will avalize the bank of the buyer, most likely the exporter's bank will fund you. Your own bank will fund you, or you get funding locally. So it enables funding. And all these instruments I'm talking about enables funding, makes it easier to be able to get funding. If the video has been of help to you, like the video, share with your friends. If you have further questions, don't hesitate to drop a comment in the comment section asking your question. More importantly, subscribe to this channel if you are new and click on the notification bell. My name is Availisation, and I'm your expert doctor, and I'm signing out. Thank you very much for stopping by today. See you in the next video. Bye for now.